All right, the day started off with some really bad news from an economic perspective. PMIs coming in well below expectations, near contraction levels in some areas. So not such good news on one hand, but on the other hand, it really brought yields down. One of the bigger drops that we've seen in yields here lately, and because of this significant drop in yields, it really pushed equities higher into the close in anticipation of what we got after the close with the strong response so far to Nvidia's earnings. And we'll talk about that implication of that report and then what we kind of need to see tomorrow morning through the pre-market session into the open and then afterwards to either end this intermediate trend that we've been on, this intermediate decline that we've been on, or will it transition to more of the type of intermediate decline that's more typical of what we've seen in the past, even the recent past, and how significant it can get, whether it'll actually turn into the type of pullback that is the beginning stages of a correction, right? Correction is you get a deeper pullback than normal, and then you get a failed pullback bounce, and then the correction, the move over. So we'll talk about how to identify between the two types of scenarios based off what we're seeing on the chart right now, so we can gauge our expectations going forward. We'll take a look at what's driving this price action, especially from a sector rotation standpoint, and then our trade idea as a stock that's bouncing up itself, that's in this technology space, and we'll talk about how to trade it. So let's go ahead and get started. Today is Wednesday, August the 23rd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel, this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that we do here. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing with this, hit the thumbs up icon, it opens up this tab, and hit that like button there. Again, the more you do that, it helps get our content out here to all of our followers on these platforms. That's why we always ask for day in and day out. Our goal is to get to 100 likes on these tweets. So again, thank you very much to those who like these day in and day out there, and those who don't, you can like right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Let's pull up S&P 500 here. You can see the rally we had today brought the near-term line continued higher into bullish territory. Again, the last three times the momentum line peaked without the near-term line was not able to get up that high. So this is a little bit higher level this go around than what the momentum line suggests. Now, granted, considering Nvidia's earnings were significantly higher, the stock is significantly higher post its release. There's a good chance we can get a good strong move to the upside tomorrow. Obviously, there could be a pretty if the move holds through the pre-market tomorrow morning, there's a good chance we get a pretty decent gap up to the upside. Whether that ends up being a runaway gap, if it ends up being a runaway gap, then you have a chance that the momentum line can really move up higher and support that near-term line getting into bullish territory and then staying there, right? It's got to get into the above the 80th percentile and then stay there for at least a few days to really kind of turn the ship around, get a bear tag, which typically starts a new intermediate rally to the upside, right? Again, that would mean that we've gone to light green shading, which we're probably a day away from getting, plus a close above the moving average, which gives us the yellow line, hence the bear tag. So we're still 1% below the moving average. And, again, depending upon 4,500 is kind of the level that the SPY is trading at currently. So we could be above that again, if it ends up being a runaway gap and doesn't fill, we could end up doing that tomorrow, as soon as tomorrow. So of course, finishing above the moving average and then getting that bear tag there. Again, similar to March 29th, wasn't necessarily a runaway gap per se, but it was a pretty decent gap and a decent move to the upside. So here is March 29th right here, and you can see down at the bottom right there, a pretty decent gap to the upside, and then a move, and then we discontinued higher, finishing not very much higher, but we went from a 1.09% gap up to a 1.45% close, and you can see that that pretty much happened right off the bat. We didn't fill in any. See where it's over here. We didn't fill in. We just went straight up from the open. There's not even a lower shadow there at all. The open was the low of the day. So which is what a runaway gap is, and didn't finish 2% higher, which typically marks the beginning of an intermediate move to the upside, but came close, and obviously probably would have that tomorrow if that's continued. And if we get that, then we have a good chance of just starting a new intermediate rally and making our run up to 4,800. 4,800 is not very far away. What's another interesting thing is that if we do end up getting that move higher tomorrow, the gap up, the runaway gap, holding the gap, making our move up, then we can actually avoid getting the 5% drop, right? Because that ended up being, if you look at this here, it ended up being about a 4.78% drop. So again, weak, because again, usually we're a little bit more than 5% on these intermediate declines. This would be a very, very weak intermediate decline. I mean, you go back to one of the other all-time weakest intermediate declines was here in September of 2021 after an 11-month intermediate rally, and we were only dropped 5%. And then, of course, the 2020s were closer to that 7% mark, and that's kind of what we've had earlier this year. So this would be even weaker than that 2021 intermediate decline that came off such a bullish move to the upside. So you get another 10% rally, which is what the last 3 intermediate rallies were, 10% or more. You get another 10% rally from here, from this close, then you're looking at 4,800 by the time it's done. So that's how close we are. If this move overnight, which is again admittedly on very, very weak volume, but if the move holds on overnight into the pre-market and then we just run away from the open without even testing filling it in, then here we go, right? Here we go with the new intermediate rally, and market sentiment's already to the upside pretty strongly. We can get that intermediate line back above market sentiment, back in the reversal zone, and basically turn it back up and just continue this long-term market sentiment. This would be we've already had 3 intermediate runs on this current market sentiment rally off that correction low point in mid-October. So this would be the 4th intermediate rally that we would be getting. That's, again, intermediate market sentiment runs typically last, about 6 to 9 months. So this would be, starting to be a little bit longer of one. But, again, it's, that's kind of the move, that's the potential. Like, we went into this NVIDIA move with the idea that this earnings announcement could either end this intermediate decline or turn it into a pullback that pretty much starts a correction. And as of right now, the initial reaction at least has been, this has got a lot of potential to end this intermediate run. It would be very, very weak, which makes us susceptible to, a more uncomfortable intermediate run, since this wasn't, this wasn't very much of a consolidation at all. As we've talked about before. But until then, right, we'd gladly take another intermediate rally up to the upside. Let's take a look at the long-term move, a long-term chart. So as of right now, it is a lower close, a higher low. It is a lower close. My guess is, we already got the green arrow. My guess is, well, if we finish up, if we can hold this overnight and finish up tomorrow, which is not necessarily a guarantee. I know a lot of people are kind of like assuming that we'll just move up tomorrow now because of what we're doing overnight. But that's not necessarily a guarantee, considering that a lot of this move tonight's on very, very, very weak volume. And once a much larger wave of volume comes in, what are they going to do, right? Are they going to take the profits of this light volume move, or are they going to build on it? And that's, again, what happens when you either fill in a gap because the wave of volume decides to take those profits from that weak volume, or you get a runaway gap when the wave of volume builds immediately off of the weak volume. So we'll get a better idea in the pre-market if there's any continuation up in NVIDIA from what we've seen so far. The MACD here, or the Heikin-Ashi differential, excuse me, is crossing up above its moving average. And again, like I said, if we get a couple of good days to finish up the week, we could get a higher close and really kind of turn this into the, a potential transition candle, kind of like this, where the next week we get this kind of move and we can really get going. Again, we've already got the green arrow. So, and you've got, like I said, the Heikin-Ashi closing above that. There's a good chance that we can continue this, that we can end this run and just continue this golden cross environment for however long. They can last for a while. So, it can continue. You can see you get the red arrows during the intermediate declines and the green arrows help end them. And that so far appears to be the case here. Looking at the 3 green arrows, we do now not have, we have 3 red arrows still in the S&P. It ended up finishing slightly lower off of the high. Again, that's going to be different. We're already at 445. Like I said, it was like, well, I guess not 4,500, but 4,450 there. So that's where we're trading right now in the extended hour. So we're up a couple bucks already as it is, which is ended up being about 0.5% or so, less than 0.5% in the pre-market trading. But that's how close you are to a green arrow that will end the pink shading. You already got that on the NASDAQ. You got the 2 green arrows here because it's been more bullish the last few days, anticipating what was going on with NVIDIA. The diamonds, of course, and IWM, which don't have the exposure to NVIDIA, nor do they have the exposure as much to that space, that high-tech space, that generative AI space. They've been lagging. They just got into the pink territory and probably won't turn green, at least for another day or two. It's interesting that the Qs here, if you look at the Qs, where is it over here? Relative to IWM, I mean, we were already pretty bullish as it was, and here we go, again, depending upon how we finish, going into this, we were already almost back at 2. And that's been a limit here in the recent past. It's been a high water mark before that. If I were to go all the way back out to like 1990 here, you can see that it was we did get above 2 previously in the 2000s. It got up to about 2.25, 2.2 before things kind of hit the fan and rolled over and really took a dive down to the downside over the course of that bear market. So here we are up at 2 again. Again, appears to be a high water mark in the short term, and then you can see that we're still in kind of this convergence mode. That the MACD is still very high. The long-term PPO is still very high. The CCI is up. The DMI is up, and the RSI is above 60. So are we starting a new stage where this takes off to the upside, where there happens to be a little bit of a negative correlation with the S&P, and that negative correlation sparked a new move up there on this ratio chart along with the S&P because of the positive correlation. It also, you can see it started some weakness late in the year, but that turned into strength by the time we got back up here to the upside. So that it has sparked some moves. Over here it sparked a downward move. So getting to a negative correlation in the past has sparked some significant moves in either direction. And like I said, as of right now, the anticipation would be, see over here in 2022, it sparked the correction move because it sparked a big move to the downside. There's a bigger gap now between the 50 and 200-day moving average than there has been at any other time besides COVID, the rally off of COVID. So really important that we do not get into that gap, that we hold this little breakdown, that we don't form a little lower high point here on the PPO before rolling over to the downside. If you look at the 2 green arrows, today's move has gotten us up above the 8-day, but not above the 17 or the 50. Again, 445 is right here, so we'd be opening up above the 50-day moving average, still below the 30 tomorrow, and the MACD is turning up and close to crossing. The stochastics is out of the reversal zone, still not out of bearish territory, but at least out of the reversal zone. So, I mean, things are looking good, not quite like, oh, we're back, we're feeling pretty good. We're not back above the 50 and feeling pretty good about it, bouncing back up yet. Again, we kind of have to hold this move here. We can't just, sell it off once the wave of volume comes back in. The DMI, we had a kind of a bearish thing going here with the ADX still above 20. It's gone. So that peak, and we're already back below 25. The negative is back above 20. So we haven't reversed, but we just have kind of lost the strength of that nascent bearish trend. You're looking at the RSI and CCI. Again, they're bouncing up, not back up in the bullish territories yet. So that remains to be seen there. And then, of course, the Ichimoku cloud. We had an intermediate trend strength, which is very typical. That's about how intermediate declines get to. We got into the cloud. We're back above the green line, not quite back above the blue yet. Again, we can get above it tomorrow at the open. We have a negative rate of change. That's not going to turn positive, not yet at least, not for a while. We've basically got to get to new highs, over the next week or so. But and we're turning pink, like we just turned pink there. So, and we're already pretty much. I mean, again, we're going to open up at 445, so we're going to open up slightly above that. If we can stay above this cloud by the time we get to that 26 days from now, then again, that's a good sign of strength for this long-term trend. The Bollinger Bands and the Keltner channels, we're not back in the upper half of the bandwidth yet, but at least we're out of the lowest quartile. We're only down there for a few days. And the bands are still outside of the Keltner channel, so it appears the momentum is turning, as you can tell there. The hull already has turned, the parabolic SAR, already has turned, and it looks like the MACD is about to cross above its moving average here relative to the 200-day hull. And right as of right now, this candle is pretty decent size. We need to follow through this candle with a good strong candle tomorrow to really break out above that 2.5% mark. Otherwise, like I said, if we fill in that gap, we're not going to want to fill in that gap. So we really need to hold the gap at the open tomorrow, run away from the open. And a lot of these reversal signs will look really, really good by the end of the week for a new intermediate trending move up to the upside. The McClellan oscillator looked a lot better, only down to minus 36, which is still below the minus 35 mark, but it was below minus 70 for rare 6 times in a row. So it is good that we're at least above 36 and have the potential, if we can get a strong rally with a lot of breadth tomorrow, we have the potential that we might not even get below zero on this if we can really get back to positive breadth as quickly as tomorrow there. Let's take a look at today's intraday move. Easily a higher high and a higher low, closing above yesterday's high, which we did not do yesterday. Yesterday we closed below the prior day's high. We closed above that high point. I told you back over here that because we had gone down so fast, there wasn't a lot of volume up here. Now again, we're going to be opening up at 445, and that's about where the resistance is. So again, we got to bust right on through that bad boy. We're a little bit above 445 there. We got to really bust through here and get up. We're not going to get a new 4-week high point. The 4-week high points has hit zero. We're not quite below 70. It'll take a few more days for the low point to get over there. But within the next few days, by the beginning of next week, if we were able to bust through this and not hit that resistance and just fill in the gap, then we can get that breakout move where the green line jumps back to 100, and now we have the beginning stages of our intermediate run. Again, that hopefully we'll get to that 10% mark and get us up to the 4,800 level. Looking at today's volume and trading range, you can see, let's see, not this one, sorry, let's look at this one first to see what it is. It's like starting to rain out there a little bit below average in the volume of 68 million. The range a little bit above the average, so kind of right at the average for both numbers. And the average right now is on the cusp of, again, breaking above this 1% mark is intermediate pullback, but breaking, staying below it keeps the trend alive, right? Keeps the bullishness alive. And of course, we want the volume to come back down rather than rise. When volume rises, then again, a sign of intermediate decline there. Again, another sign of being the weakest intermediate decline we've seen is this intermediate decline has a VIX that potentially will have peaked barely into the neutral zone, right, during this little rally, without the VIX getting above its 200-day moving average. And you can see the sharp drop in the VVIX and the VIX itself. The correlation did drop below 50% there. So we'll see if how long this lasts. But as of right now, they're kind of following in suit with each other to the sharp drop from a much higher high point on the VVIX that the VIX ever got to. So another sign that this would be the weakest intermediate decline. Considering that even complacency didn't consolidate. The VIX rose, but it didn't jump where it typically jumps up to 100% plus relative to the VVIX and above its 200-day moving average when you're looking at it relative to its own average, historical average values. It didn't even get above the 200-day, just filled in the gap. But typically during intermediate declines, you do get above the 200-day moving average there. All right, now let's take a look at what's driving a lot of this price action here today. So let's go out to our comparison chart here and just look at today just by itself first, and then we'll look at some other time frames here. But just today itself, you can see that's the biggest driver right there. Not the fact that bonds were bullish, but more that bond yields were down. So bond yields were down. The dollar was down. Commodities weren't down, but they underperformed everything else. That's your three-headed bullish monster, right? Is falling yields, and yields finished at their lows of the day. A lot of today's move was kind of attributed to anticipation of Nvidia's earnings, but it really came about because of the weak economic data that put pressure on yields right from the outset. And then you can see throughout the rest of the day put a lot of pressure on yields. In fact, if you look at the 10-year yield, let's look at the 10-year yield here. This is one of the bigger declines. In fact, let's just go to the price movement here. This is one of your bigger declines that we've seen in a while on the 10-year yield. Ended up being down 13 basis points there. Again, kind of right about the same amount that we dropped there on August the 4th, to kind of give you an idea of what that move looked like on August the 4th. Let's go back over here and go to TNX. So there was August the 4th right there. It's a pretty big move to the downside. We went from 4.189% to 4.06, and so you kind of had a similar move. That time you stayed above the 8-day moving. You were just so far above the 8 that you dropped so hard because you were so far above it. You kind of had a very similar, but this time we dropped below the 8, just not below the 17 as the MACD there appears to be crossing below its moving average. And the stochastics also crossing below its moving average. It is a higher high, and we've come down from these other highs here to higher lows. Now the question is, will we come down to another higher low, hit that 30-day moving average, stay above 4%, and then rally up to the upside? But there was a big sharp move in TLT, getting above the 17-day moving average for TLT after being below the 8 for so much, and really having this divergence, right? A lot of people I've seen on Twitter talking about this divergence in TLT with the higher lows on both the CCI and the RSI, but the RSI, both of these lows are below 30, and then obviously now coming off of the lower low, much lower low, again, crossing through that high point would be a change in trend, and if we do get above that high point, again, that would mean yields are falling, and you'd be probably back above the 30-day at that point. You'd still be below the value area, so you still wouldn't be like trend changing, but that's definitely probably the biggest reason right there why equities were as bullish as they were today. Again, outside of the anticipation of what was going on with Nvidia, at least what was expected to go on. The dollar also had a little bit of a bearish pattern, also crossing below its moving average on the MACD. Stochastics coming down, a little bit of a long upper shadow, a little bit of a shooting star pattern here. right at the 200-day moving average. So now the question is, we stayed above the 8, but the question is whether or not we're going to hit some resistance here and at least have some short-term weakness. So you can kind of see the big drivers really are those two particular moves were the biggest drivers for today. Now, if you go out to NDX, you can see we really had, it's really from the 18th on is when things have taken off, and that hasn't necessarily been, the all yields. If you take a look, let's go to the 18th going forward. Bonds were, again, most of it's up today. It was actually down on Monday, so it's not all. All this strength hasn't always been, what yields have been doing. There we go. Get a little better perspective, but you can see even going into today, where yields were up slightly, the Qs were still up, and so it really is the Qs that are leading a lot of this charge. Off of those lows on the 18th there from early on Friday through the rally. You can see commodities were initially pretty strong. Yields or bond TLT was up, which means yields were down there, and then yields really took off on Monday, and then we're still up there on Tuesday before dropping big time today. So big time move on TLT to go from pretty much the worst performing asset class to the second best, outpacing gold. Obviously, gold benefiting today from the drop in the dollar. That wasn't necessarily the case before, but it's been bullish for most of this period. You can see pretty much all these equity asset classes, but high yield in particular underperforming TLT. Let's take a look at high yield relative to its corresponding duration bond, and you can see it actually outpaced even IEF. Remember, IEF is more tied actually to the 10-year. TLT is more the 20 to 30 year. So HYG actually did do better than IEF today. So keep that in mind. It wasn't necessarily an underperformer from that regard. Getting back above the 8-day moving average. And as I showed you, the Qs really performing. Interestingly enough, again, as we take a look at the sector moves, and I showed this on Twitter, the sector moves over that 6-day period. Let me come back to the comparison chart. When you look at that 6-day period through yesterday, where the breadth was so bad that the McClellan oscillator was below 70 for 6 days in a row, which we hadn't seen since COVID, right? So 1, 2, 3, 4, 5, 6, all the way up through yesterday. So this is what it looked like from a breadth standpoint. Obviously the markets were down about 3.25%, and a lot of that weakness came from technology, communication services, discretionary, and your cyclical areas were down too, so that's why breadth was so bad. Pretty much everything that was down except for these small safe haven sectors. Utilities actually held their value over the next 3 days, but look at what technology did from Friday morning going forward. It took off. Everything took off. Communication or discretionary took off. It just didn't go up as much. Communication services really took off. Initially didn't go up as much until today, but really big bounce today. They're still, lagging the S&P, but you can see all these cyclical areas that were outpacing the S&P barely are all now underperforming. Financials and energy, materials, industrials, real estate, all underperforming the market. The really only big outperformer is technology, being up here now almost a full percentage point over this last 7 days. Right now that we look at what happened here today. So in terms of just how bearish we were initially during that really bad breadth period, we ended up actually up over the final 3 days of that period. And then, of course, today's rally and what could be tomorrow's rally leading us up above the zero level and leading us higher if we can get these bigger cyclical sectors to lead us up in the upside. So hold this gap up tomorrow morning and then run away from it, right? That's the whole intent. Led higher by these areas. And I want to take a look at XLK. The last time XLK had this relative strength that was this bearish and then a renewal of momentum to the upside, bringing the XLK, the ratio chart with the SPY up above its moving average, was back at the beginning of the year. And you can see it started a really good intermediate run, broken up with a small intermediate decline there and a convergence period there. But it pretty much started a pretty decent run of outperformance with some good relative strength. And we'll see if that ends up being the case again as the momentum has turned back above 100 and is starting to bring that relative strength line up with it. Now, typically when it's this bearish, you can, like as you can see right here, it's hard to get above 0 or above 100 and before we turn back down, and that's obviously was the case during this bearish decline. If I were to zoom out a little bit more, you can kind of see what the correction looked like here as technology underperformed this entire time, and then we rallied, and you can see periods where momentum turned positive, especially like right here, but the relative strength really didn't, and we turned back down and stayed bearish. So that's something to keep in mind, considering how low we got on the relative strength line with the momentum turning above 100. There's a good chance that that relative strength never gets to 100. In fact, I wouldn't be surprised. That's kind of what I'm expecting is the momentum will turn over before the relative strength line can make it all the way up, especially make it up to 101 plus, which is where a lot of these runs end with technology getting to these peaks on a relative strength basis. XLC was the other big mover, and you can see it's been outperforming for pretty much all year long relative to the 50-day moving average. It's actually losing momentum right now and losing relative strength. So we're not quite seeing this as strong of a bounce here as we did in XLK. Let's go back to that 12 grid chart. Remember, a lot of these areas were turning dark pink shading in a red line. Let's go to the 12 grid right here. You can see now, again, communication services and technology are above 20 on their intermediate lines, and they're rising. So we have light green shading, and if we still have a red line, energy is still above its moving average. Healthcare has got light pink shading and a yellow line, so it's looking like a bounce. Everything else is pretty darn bearish with the dark pink shading and a red line, and today's move hasn't necessarily altered that yet. We'll see if it continues into tomorrow's move. All right, let's take a look at our trade idea for the day. Let's take a look at IBM. IBM, again, we put this on during the Market Outlook Live before the market closed at 3:30 Eastern time. IBM had been bouncing up, so during this pullback it never did get below the moving average. It did get pink shading, so we got below 80. In fact, it got below its market sentiment line. But it turned back up here before getting the bull tag. The last bull tag it got here in June and July were also bullish. We bounced up immediately, and so we kind of had a similar pattern, though we bounced up kind of intraday immediately off of those extremely oversold momentum and near-term lines. Now your near-term line is actually above the intermediate line and rising back, hopefully into the upper reversal zone as we continue a bullish move to the upside. So now it's just a matter of showing you how on all these charts how that pullback wasn't as bearish. I mean, we didn't even get a red arrow here. We basically have two transition candles that is actually, as of right now, likely to turn pretty bullish again next week. That would be the expectation there. Looking from a 3 green arrow standpoint, of course, you have the green arrow on the moving average as you're still up above it, but the MACD is not turned green yet, so the MACD is still below its moving average. Stochastics has turned green now. It's jumped up above its moving average and rising. So you're that close on the MACD to getting 3 green arrows coming off of that low point there. Looking at some other oscillators, you can see, again, we have been relatively bearish, but we didn't get very bearish, and the negative indicators dropped back down, the positive bouncing back up. Looking at the RSI and the CCI, we kind of looked at that. Coming off of, avoiding getting into bearish territory, at least the RSI. CCI got a little bit down there, ended up down 170, but now they're both back up and flirting with getting back in the bullish territory. looking at the the Ichimoku cloud. You can see we got back above, we didn't get below the blue line. We got back above the green line. We lost our trend, but you are back up, above the cloud, above both lines. The rate of change is positive, so more than likely, if we continue higher, we'll get that trend back. And then finally, looking at the Bollinger Bands here, the bandwidth falling to extreme lows, so setting up for a squeeze play, and then again getting into the upper quartile here. With the momentum transitioning back to being slightly bearish to being bullish again, would suggest that we'll break out of this to the upside. So watch for that next day or two, especially if there's a positive reaction on this stock to what happened with NVIDIA today. So what we decided to do is to do a relatively high probability long call vertical spread, try to keep the reward similar to a bull put spread. Which is kind of hard to do right now considering the deltas and you're not getting paid out very much. So we decided to buy the at the money call option and then go out a few strikes, and it sets up the trade like this. So we're getting a with the trade that actually filled in $600 for a little less than $600 of reward. So about twice is what we typically get for $1,000 of risk, but getting it for far less than $1,000 of risk with a relatively decent probability, similar to a bull put spread of making a little bit lower, of course, than a bull put spread, but an opportunity that if we get up to these highs and stay there or go beyond there, then that's how we make our money on this particular trade. All right, that is it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have and reply to anybody else's thread, and let's keep this conversation going in between videos. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Join our Market Scholars YouTube video. Like us there with the thumbs up icon and comment on anything down below. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.